Hey everybody, welcome to December. Hope everyone had a good Thanksgiving. A couple of things to chat about today. First one is I want to do a quick update on just what's happened since we spoke last, and then talk a little bit about what we think is going to happen in the near future. So how the year is going to play out, and most importantly, or more importantly, how next year looks after the year we've had this year. So let me share a couple things with you. And we'll see how things, first of all, have gone since the last time we spoke. So this is the same chart we were looking at of the overall market, the S&P, when we did our update a month ago. So if you remember from the last video, we had the trend line down here with really solid support at the 200-day moving average, which is the blue line, and also the red line, which is just the overall trend support. Then we had the upwards kind of wedge forming with both of the up and the down. You can see that we broke pretty significantly right through the trend line, right through the moving average, and we were hovering down here, and we were kind of finding some footing down here. And we said that we would probably, maybe find the support we needed to start to move back higher back then, but might chop around there for a second. And then this is what happened. So pretty much moved straight up from there. So as sharply as the market moved down, moved even more sharply back up. I'm gonna get rid of that. December was great. Had a really sharp move higher, moved right back through the moving average, moved right back to the trend line, both trend lines, even both the top and the bottom ones. And now we're here. So now we're again kind of finding an area of choppiness, kind of like we found down here, where we may need to stick here for a little bit of time. Might want to roll over and pull back a little bit. That'd be completely normal to see after a big move higher like this. But even so, we're getting really close, and we actually momentarily broke through the previous high from back in July, which is great. So we didn't really decisively move through, which, it's okay. It would have been nice to see that happen, but just because it didn't happen doesn't mean it's not going to happen. We may just need to take a little bit of a breather here. Again, when markets make fast moves like this, a lot of times it just needs some time to gather itself, consolidate, form a base before it starts to move back higher from there. So, looking back at this overall trend line of where the market's kind of found some support in the past, it wouldn't be abnormal at all to see a pullback down to, this area somewhere here before moving back higher and then making that kind of final push through these recent highs, moving towards more of the all-time highs. So this is back in 2021, the all-time highs we made before we had a pretty big pullback all of last year. That will be significant resistance. Like there's going to be a lot of, it'll be tough to make it through that. We obviously will at some point, but it'll be, when we do move past that, that'll be a very good sign to really just move higher from there. So as chart wise, or just kind of where the market sits wise, we're kind of back at a high point where we might just need to hang out for a little bit of time before we have the energy to move higher. I will say that the reason that this bounce happened is the same reason that this kind of from here downturn happened. Rates went down. This upward move here was killed because rates went up. So we made it all the way down here. This downward move was killed because rates went back down, moved all the way up here. So rates this year have been really correlated with interest rates, meaning again, higher the rates, lower the stocks, lower rates, higher stocks. Stocks do not like higher interest rates. And more importantly, that's not always true, but more importantly, they don't like rates that are moving quickly up fast. I mean, if rates trend higher over a long period of time more slowly, stocks can digest that, and that's okay. It's when rates move shockingly higher that stocks don't like it, but also when rates move shockingly lower, stocks really like it. So in times of rates moving quickly, they're more correlated with stocks. But that's not always the case. And that's looking like it might be turning into not the case right now, because rates today, for example, we're making this video, are lower, and so are stocks. So it gets to the point where rates have come down a lot, And now it's becoming less correlated, because if rates come down too much, the stock market's going to start to worry, are rates coming down for a bad reason? Meaning, is the economy slowing down so much? Because typically when the economy slows, people buy bonds, and people buy bonds, rates go up, or I'm sorry, rates go down. So now the markets may be considering, well, are rates actually a good thing? Because if they're really low because the economy is slowing down dramatically, that's not good for the market either. So we're at kind of a turning point where, you know, rates and stocks may become a little bit less correlated depending on what how it all shakes out, and if the market considers the correlation a bad thing. But that's the reason for these two big moves. Big move down because rates kind of went a lot higher really quickly. Rates went a lot lower really quickly, so we had a big move up. All right, so that's what's happened. Let's kind of chat about what we think is going to happen moving forward. So the one interesting thing that I have been watching lately for the past week or so is how the S&P 500 index has been performing compared to the RSP, which is an ETF that follows an equal weighted S&P index. The difference is the S&P index is a weighted index, meaning the bigger the company, the more weight it has inside the index, the more consequential its returns are. So right now, Microsoft is the biggest company in the S&P. Its weighting is ballpark numbers 7%. So the returns of Microsoft, if Microsoft has a great day, that's going to help the index a lot, because 7% of the index is based on Microsoft's returns. And it's incredibly heavily weighted on the upside. Even the 15th biggest company, which I believe is Broadcom at this point, has about a 1% weighting. So even between number 1 and number 15, number 1 company has 7 times more effect on the index than just the number 15th company. The number 500 company is, I believe, Fox Corp, has a 0.01% rating, meaning Microsoft's returns are 700 times more consequential than whatever the returns are of Fox Corp does every single day. So if Fox is up 100% and Microsoft is down 1%, it's going to be about an equal weighting, or actually it's not even going to really even be close to a green day for the S&P, because Microsoft is it's so much more heavily weighted than Fox. And that goes for the majority of the smaller companies out there. Their weightings are a fraction of what the bigger companies are. What that means is if the bigger companies do well, it doesn't really matter what the little companies do. The index is going to go higher, and that's vice versa. The big companies do don't do well, and the rest of the market does. It doesn't really matter. The index is going down. So RSP, the ETF RSP tracks the S&P, but on an equal basis, meaning that every company has the exact same weighting. It's a really good way to get a feel for what the broad market's doing, as opposed to what the heavily weighted just overall index is doing. So check this out. This is a chart of the S&P 500 regular index this year. Let's see. Performance-wise for year to date, it's up like 21% or so. Okay, that's great. If you do the exact same chart for RSP, the equal weighted index, it's up about 7% for the year. So, I mean, the S&P, the weighted index, is up 3 times more than the overall index, which tells us that the bigger companies are having a far bigger impact, or they're the ones that are doing well, while the rest of the index is struggling. So what we can do is do a ratio chart. A ratio chart is where you compare two investments, how they're performing. We actually do this a lot when we're trying to figure out what sector we think is going to perform well. So as we're picking or deciding what stocks go into the portfolio, usually our process is, first we want to choose what sector is going to do well, and then out of that sector, what are the best stocks in that sector. But you can do the same thing for indexes, to compare overall indexes and how they compare. So a ratio chart between RSP and SPY looks like this, trending basically down for the entire year, which just means that the S&P is outperforming or performing better than the RSP. The index, the weighted index is performing better than the equally weighted index. So RSP compared to SPY trending down for almost the entire year, except look what's happening just for the last couple, like the last week or so. The equal weight index is really picking up steam. And that's kind of what we think is going to happen for the rest of this year and also into next year is the big companies that are the heavily weighted ones in the S&P have all made really big moves this year. NVIDIA is up 100%. A lot of them are up a lot. That can't go on forever. So our thoughts are people are going to reposition out of those big companies that have been doing really, really well and into a lot of the laggards that have just kind of been left behind this year, because within that equal weighted index or outside the top 7 stocks, there are a ton of great companies. But they've just been overlooked this year because the big companies have been doing so well. Our thoughts are that starts to change a little bit, where next year we start to reposition into some high quality, just not so big companies, and the general market breadth will improve. And the big companies, I don't think will necessarily sell off and crater, but they just won't probably, they might hang out and be flat, or they might chop around a little bit. They just won't have the type of year they had this year. But that's good because in a properly diversified portfolio, you don't want to have 10% Microsoft and 10% Apple. You want to have a little bit of everything. So a properly diversified portfolio of really high quality companies should do pretty well next year, which is great because that's the kind of investing that we do. So yeah, that's something that we will track going forward, but it's something that is interesting to see how the littler companies, and they're still huge companies, but still smaller than the mega cap companies out there, how they're starting to look a little bit better compared to the overall market, which is really good to see, because a healthy market is one that not 7 stocks are doing well, but that a lot of, or the majority of stocks are going up, not just the big ones. So we'll be tracking that. We'll follow up on this next month and see if this continues. But that's all I have for you for today. If you have any questions, of course, obviously, email, reach out, and we'll chat. But if I don't hear from you, we'll talk to you in a month. So everyone take care. Have a good holiday season. We'll talk soon.